UPS versus Texas Instruments. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And today we're going to be doing something a little bit different. I got this suggestion in the comments a couple days ago from a guy named Brigham West, and it was sort of asking me what I thought of comparing UPS to Texas Instruments and what I thought of each of these stocks, which one I thought was more favorable, and which one I would be more likely to invest in. So I was like, this sounds like a great idea. I think I want to turn this into a series. So what we're going to be doing is, in this video, I'm going to compare UPS to Texas Instruments, tell you which one I like more as an investment and why. And then in the comments below, I want you guys to leave me your suggestions for the next video. Give me 2 stocks that you want to see me break down which one I think is a better investment right now and why. And I would love to do that. So whichever comment below gets the most thumbs ups on it, that will be my topic for the next video in this series. So be sure to leave any 2 stocks that you're wondering about, that you're thinking, do I want to invest in this one or that one? Leave them in the comments below and I will cover them in my next video like this one. So I figure I better give you guys an explanation of my criteria before we go into this. So basically what I look for in my investments, I am a long-term value investor. So I look for investments that are currently undervalued or fairly valued, that I think have huge growth potential in the long term. I'm not looking to buy a stock today, see it double tomorrow. I am looking to buy a stock today and see some solid growth over the next 5-10 years. So that is my investing strategy, and that is the perspective that I'm going to be going into these companies with. So I've sort of simplified down my criteria that I look for in a stock to 6 key indicators that can give you a pretty good idea of what the bigger picture of this stock looks like. Now, when you're making an investment, I would definitely not recommend just looking at these 6 indicators, but looking at the balance sheet, looking at the income statement, looking at all these different factors that go into a company. I can make a video on all the different things to look at some point if that's something you're interested in. Otherwise, these 6 give you a good overview picture of what a company is doing, but it shouldn't be the whole picture that you're getting. So let me just cover each of these individually. So we're going to be talking about market cap. So how big is this company? Market cap really just shows how much the total company is valued at based on how many stocks are out there and how much each stock is worth. You just get the market cap by multiplying outstanding shares by current share price. Next, we've got our PE ratio, which is your price to earnings. Made a whole video about that. But in basis, it's just basically how much you are paying for each dollar of company earnings. So say the PE ratio is 19.5, you're paying $19.5 for every dollar of company earnings. Price to book ratio is how much you're paying for each dollar of company assets. So say this company owns $1,000 worth of assets, and their market capitalization is $10,000, their price to book ratio would be 10 because you're paying $10 for every dollar of company assets. So what price to book ratio sort of symbolizes is how fairly valued a company is, if it's overvalued or undervalued. I did a whole video on that one as well, so be sure to check that out. But basically just how fairly valued a company is. Price to earnings growth, next criteria, that basically is just going to show you how much future growth of the company is factored into their share price. So if you've got a high price to earnings growth, that means that a lot of future growth is already factored into the share price, and the price is sort of a little bit inflated compared to how much the company is actually worth in this moment. So people are counting on future growth driving the share price higher, so generally you want to see a low price to earnings growth ratio along with a low price to book ratio. Next, we've got our current ratio, and that sort of symbolizes how readily a company can deal with a short-term expense that comes up. So how much short-term cash or short-term investments do they have on hand to deal with a expense that sort of comes up in the short term? So do they have a lot of cash on hand? Are they sort of strapped for cash? Are they buried in debt? Current ratio is going to give you a little bit of a picture on how readily a company could deal with something that came up like that. Next, return on invested capital. So basically for each dollar a company puts into their company and invests into their business, what is their return on that? So how much money are they getting? Generally with that, I want to see at least a 20% return on their invested capital, just because that means that they're doing a good job generating income and generating returns on the money that they're putting into their business, and they're a profitable business. Lastly, our dividends. So I made a whole video about dividends as well, but that's just your quarterly payments that the company is making to shareholders to encourage them to stick around and to be invested in this company. So those are my criteria, and now let's talk about each company individually. So our first company is UPS. And I mean, everybody knows UPS. They're a transportation and logistics company. They trade under the ticker symbol UPS. Go figure. And they are currently trading at a share price of around $109. So actually both of these companies are trading at about $109, which is kind of convenient. I don't know if that's why Brigham Young suggested both of these companies, but it might just be a coincidence that they're both trading at about the same share price right now. So it makes a comparison, I mean, a little bit easier, but share price really shouldn't play a role in deciding whether or not you're going to invest in a company. It doesn't really say a whole lot about the investment itself. Okay, so over the last year, over 2017, UPS grew at a rate of about 6.8%, so significantly lower than the nearly 22% growth that we saw in the S&P 500 as a whole. So they only grew about 7% last year, and in 2018, they're actually down about 11.6%. So UPS is on a bit of a dip right now, and that's definitely going to influence my decision on whether or not they are the superior company right now. So currently they're sitting at a 96.4 market cap, which makes them a large cap company. They are a big company. A lot of people know UPS. They are probably the ones who bring your packages around all the time when you ship stuff. So a lot of people know UPS. Their price to earnings ratio is at a 19.5, which is, I really like to see that because the average in the market right now is sitting at about a 25. So seeing a low price to earnings ratio makes me happy, because that shows that the company is not too overvalued right now. So I really like to see that 19.5 price to earnings. And then their forward price to earnings is actually a 14.6. So seeing a sub 15 forward PE right now, that is really, really nice. I really like to see that on a company. So I'm gonna circle that because I really like to see that price to earnings and that forward price to earnings. Okay, next our price to book. So this guy needs some explanation. Generally with a price to book, I like to see something between like a 1 and maybe a 3. Now a 94.6, that is a lot. That is a lot of price to book. And the reasoning behind that is because, I mean, price to book isn't a very applicable thing to UPS because the business that they're doing isn't heavily reliant on their assets. They're not getting their value in their company out of their assets, they're getting it out of their transportation services. So they're more of a service-driven company, and their assets are not a big part of what makes UPS a successful business. So the price to book, I mean, it's not very applicable for UPS, and generally, I mean, it's not like a relevant thing. I wouldn't take it into account here, just because they're not a company that's heavily reliant on assets. That's not what's driving their business. Their business is based on transportation and logistics, which is not a very asset-intensive business, so price to book is not very applicable for these guys. All right, our price to earnings growth sitting at a 1.6. So, I mean, that's pretty good. A price to earnings growth over 2 is generally, in my opinion, steer clear because there's a ton of growth already factored into that company's share price. So the 1.6, pretty good to see. I guess that's kind of middle of the road for me. But I do like to see a low price to earnings growth ratio because that means that future growth is not already factored into the share price. And when the company grows, their share price will also be growing. All right, our current ratio is sitting at a 1.2, which is very, very nice. Generally, a current ratio, again, below 3 is ideal. So that current ratio of 1.2, I like to see that. That is a good thing in my opinion. They're very able to respond if something were to come up in the near future. They would be able to get on top of that and get that all sorted. Next, our return on invested capital. So that's at a 25.5, which is very, very nice. To be able to get 25% returns on all of the money that they invest in their business, that is something that I like to see as well. So I'm enjoying that there. And then the dividend, 3.5%, pretty significant dividend. Most dividends are going to range you anywhere from maybe like a 1 or 2% up to maybe a 6%. I wouldn't go above 6% because a lot of companies that are paying dividends above 6% can't actually afford that. But yeah, a dividend of 3.5%, that is also quite a nice thing to see there. And I do think that is very beneficial to UPS as a company. All right, and in general, let's talk about some fundamentals of UPS. So they're really focusing right now on ramping up their network. So they're focusing on acquiring more business rather than raising their prices. So they're trying to keep low and competitive prices and acquire more customers so that they can continue to do business and continue to grow. So yeah, they're focusing on keeping those prices low. However, their share price, I talked about it was on a dip. It's almost down 12% this year alone. So what is up with that? That is because people are scared of Amazon taking over. So like I've talked about in a couple videos, Amazon, they're on their way to take over the world. Amazon actually rolled out a competitor to UPS, a direct competitor in LA that potentially may scale nationwide. So that inspired some fear in the shareholders of UPS, and that sort of caused the share price to spike down. But I do think this may be a good opportunity to buy the dip. I do think it's a bit of an overreaction by people. So if you do want to get in on a bit of a dip, this might be a good opportunity for you. Who knows? And in my opinion, people are going to be buying stuff online. They're going to be sending packages for decades to come. So I don't think UPS is in any danger of going out of business in the near future. That is just my opinion. Let's move on to Texas Instruments, who trades under the ticker symbol TXN. All right, and like I said, they're also trading at about $109 right now, just like UPS. And what Texas Instruments does is they're in the semiconductor and automotive safety industries. So they have some exposure to self-driving cars. So if you want to get on self-driving cars, just some like side exposure, this might be a good idea for you. But their main business is their semiconductors, and then they also do a little bit of like automotive safety and sensors as well. All right, so Texas Instruments is actually up about 46%. They were up 46% in 2017. They saw some very, very nice growth in the year of 2017. And so far in 2018, they're actually up 4.3%, so not too shabby for their returns over that time. Again, the average return in the S&P over 2017 was somewhere around 22%. So they were more than double that, which is very, very nice to see. All right, so sitting at about 108 market cap, which makes them a little bit larger of a company in comparison to UPS. But again, they're both very large companies, very big companies in general. Looking at that price to earnings ratio, it is pretty significantly higher than the price to earnings ratio of UPS. So we're comparing about a 20 to about a 30. And then that 4 PE ratio it's looking pretty nice. So 22.4, I can get behind a 22.4, but I do like the price to earnings of UPS a little bit better, just because that 19.5 is a little bit more appealing to me than that 30 over on Texas Instruments. All right, now looking at their price to book ratio, again, it's really high in my opinion. Not nearly as high as the 94.6, but a 10.4 is still very significant to me as an investor, as a long-term value investor. So in comparison, the industry average of their industry, of semiconductor industry, is actually a 2.42. So the 94.6, it's not a relevant indicator for UPS, but this 10.4 is a little bit telling of Texas Instruments because that is a little bit more of an asset-driven industry. So seeing that as nearly 5 times the industry average makes me not too confident in that investment that you are not overpaying, because I think a high price to book ratio can symbolize you overpaying for an investment. So I'm pretty hesitant to get behind that 10.4 with Texas Instruments. So looking at the price to earnings growth, pretty similar to UPS, a little bit higher, but I mean, that's pretty negligible, 1.6 to 1.7. So not a ton of future growth factored in to the share price, but again, there is some there because that is higher than 1. If it was at 1, there would be no future growth factored in, but since it is at a 1.7, just like with the UPS, there is some future growth factored in to that number. All right, next we got our current ratio. So that's sitting at a 3.9, so pretty significantly higher than UPS, so they don't have as much cash on hand to deal with a sudden expense that they weren't expecting or a sudden emergency. So that's a little bit inconvenient, but not a deal breaker for me, seeing that higher current ratio over there. Next, we've got our return on invested capital. And this one's a little bit more significant for me. Just seeing about half the return on invested capital when compared to UPS is not very encouraging to me, just because it shows that they're not getting the most bang for their buck when they're investing in their own company. A 13.8% return on invested capital is decent, but in this economy, I think they could be doing better on that. So again, I don't like that 13.2 number, and it's not very encouraging to me. Lastly, our dividends. So they do pay a dividend, which is nice. They pay about a 2% dividend, so not too shabby over there, but it is, again, significantly lower than our dividend we're getting from UPS. So what is Texas Instruments doing right now? They are currently getting involved with some self-driving cars, and additionally, they are consistently growing their earnings. So over the last couple of years, they've been consistently growing earnings year in and year out. So I think that is a pretty good sign for the company as a whole, to be able to see those consistent growth in earnings. I think that shows some huge growth potential for the future. But let's get to the verdict. Let's get down to my reasoning, who I think wins, who I would consider investing in, and why. All right, so just off the bat, I think both of them actually look like great investments. I don't think you could go wrong here, but there is a clear winner in my opinion. So I think they both look good because first we've got this PEG. These are looking pretty nice. Not too high there. They've got some future growth factored in, but again, not too much. Again, they both pay dividends, which is great. Great to have that dividend income that is coming in every single quarter. And they're both large cap stocks. So they're both pretty well-established companies. I mean, very well-established companies, let's be real. But I think there is a lot of merit behind having a large cap company. It's a good way for investors to get started. I would definitely recommend getting started with investing in large cap companies because they're a lot more stable. They're not going to go bankrupt tomorrow. So I think that is a good reason to get involved with these companies as well. But the winner, it's gotta be UPS. Gotta be UPS. In my opinion, UPS is the clear winner of this comparison. And why is that? First off, that low PE. That low PE, that's a winner in my opinion. Having that PE below the S&P 500 average of about a 25. This guy, we're a little bit over our 25. So UPS definitely wins on PE basis. And that forward PE of 14.6, I really do like that as well. Next, our return on invested capital. So this one's big. This one is really big. And I really like that 25.5% number. I think that shows that UPS is doing some really good stuff right now. And they have some huge potential for the future. And they're getting very nice returns on their investments. Next, we've got our current ratio. And I mean, in comparison, this 1.2 is much better in my opinion than a 3.9. So it's got to win on the current ratio basis as well. And lastly, I think it's just a really good opportunity to buy the dip. So we're down like 12% on UPS right now just this year. And we had that huge spike downwards with the fear of Amazon coming in and disrupting the space. But I think UPS is a very strong player for now. I think it's going to be some serious time before Amazon is all across the nation. I think UPS has a lot of life left in them and a lot of growth, and this Amazon thing might not even work out. Amazon might be like, oh, this was worth a shot, but I think we want to devote more of our time and energy into, say, the grocery sector. So who knows? Amazon might not even stick with this project. So I think a lot of people are just overreacting to Amazon's entering this space because everybody knows Amazon is just a powerhouse in whatever they decide to take on. But who knows? In my opinion, UPS is the winner. So be sure to let me know in the comments below what your suggestion is for the next video. What two stocks do you want to see me put head to head and see who comes out on top? Anyways, thank you for sticking around. I really do appreciate it. If you did enjoy, leave a like, subscribe, share the video. You know the drill. And I did actually just create a website called applecreator.com. So if you're at all interested in that, check it out. I got a blog going on over there. So some cool stuff in the works over there as well. Check it out. I'll see you tomorrow. And until next time.